Hello, everybody. Welcome to Trade webinar brought to you by Kenanga Investment Bank and managed by Wealthford. Today, we are very excited to be doing this topic, Malaysia Market Outlook 2023, Earnings Resilience to Weather Macro Headwinds. So welcome everybody to this session. My name is Shen Chu. I'm the moderator for this session. Now, this is the first Trade webinar for 2023, and we are very excited and glad to see you here today. Our session today will talk about what are the opportunities for 2023 and what are the sectors that will show earnings resilience that can weather through the macro headwinds. So today we are very excited to invite the head of research, Mr. Joshua Ng from Kenanga Investment Bank to share with us on this topic. So before we begin, as usual, disclaimer. So whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risks. So without further ado, let me just invite the head of research from Kenanga Investment Bank, Mr. Joshua Ng, to present on this topic. So very nice to see you here, Joshua.
Hi, Shane. How are you?
Yeah, I'm good. And you?
Fantastic.
Right.
Let's get started.
Perfect.
Shall I just proceed?
Yes, you may proceed to share your slide. All right, fantastic. We are seeing your screen right now. Yes.
Okay, give me a second. I just move. All right, can you see the slide clearly?
No, now we are seeing your desktop.
Sorry, there's some technical issue here. Let me
just now it works. Right, for those of you who just tuned in, this is the first Trade webinar, and we are very glad to see you today. Just give us a moment while we are putting up the slide. So Mr. Joshua Ng is a heavyweight in the Kenanga research team. He's the head of research, and today he's going to share with us what are the opportunities in the market, what are the possible risks, and what are the sectors with earnings resilience that can weather the macro headwinds. All right.
All right. You can see my slide now, right?
Yes, we can see it.
Okay. My head may look a little bit not so natural because I'm looking a bit sideways on the screen. But anyway, okay. Let's get started. Basically, if you look at the title of my presentation, macro headwinds and earning resilient. These are the two things that you would have to watch for 2023. It could be whole of 2023 or could be part of 2023. Okay. The very first thing, macro headwinds. This is the underlying assumption you have to impute into your model when it comes to investing in 2023. Why is that? There is a looming recession in the US. This is something that you cannot ignore. However, second thing, earnings resilient. This is how you can actually outperform the market despite all these macro headwinds. I think the new year has actually started. You've been trading the markets, and some people could be lucky enough to have made some money, especially this morning. Those who bought Nation Gate would have made money. But I guess you know that 2023 is not going to be an easy year for you, and not going to be an easy year for everybody. It's going to be very tough. If I'm telling you that this year is going to be hunky-dory, I am actually not even sending across the right message. So, but of course, you yourself, is an investor or you are actually advising your investors, you're being given the mandate to actually ask them to invest. And from your experience, you actually know that the greatest opportunities actually present themselves when fears actually rule the markets. I think it is very much the situation right now. Okay, the thing is that we all want to invest, but we want to time, the exact timing when we want to jump back into the market in a big way. This is not going to be easy. I think you really have to consider two things here. Number one, whether there is going to be a recession in the US. Number two, if there is a recession in the US, how deep and how long the recession is going to be, because that would actually decide when you would actually jump back to the markets. And basically, we do not quite have the answers to the question as to when the market is going to bottom and whether there's going to be a recession in the US. But what we can actually do is to act based on what we know at this point of time. And we will actually have to adjust our strategy and modify our investment plans along the way. So what do we know exactly right now? As I mentioned to you just now, there is a strong likelihood that the US will actually slip into a recession. If you look at the chart at the top, that basically shows you the recession in the US over the last 40 to 50 years. The gray areas basically represents recession periods in the US. Since the late 80s, the Fed, during 5 occasions, actually embarked on rate hikes. Out of the 5 occasions, 4 of them actually resulted in a recession. And the latest one, i.e. in the year 2020, you can argue that the recession was not quite because of rate hike, but because of COVID. But statistically speaking, you are talking about 4 over 5, 80% chance that US will actually slip into a recession after the Fed actually raised rates. And this time around, if you look at the chart, you look how steep is the curve. It's actually the steepest ever since the 1970s. So that gives you a good idea as to how likely the US is going to slip into a recession. And based on historical data, normally the recession will actually hit about 9 to 18 months after the rates in the US actually peaked. So when the rate is going to peak, if you look at the table at the top, this is basically the Fed Fund futures traded live in the US. Market at this point is looking at US rates to peak around March this year at 5%. So assuming the rate is to peak in March, so the recession may actually hit towards the end of this year. But some of the global strategists actually predicting that the recession can actually hit as early as middle of this year. That depends a lot on the strength of the labor market in the US. For those who actually follow US data, last week they have December private sector payroll ADP that actually came in stronger than expectation, 235,000 against estimate of 150,000. So the labor market is still strong, which means a recession may not hit anytime soon. But the irony is that if the labor market is strong, that gives the Fed even stronger excuses to keep raising rates. That could result in an even deeper recession. So we just have to follow or monitor the data very closely. In fact, today 9:30, there would be December CPI number. This is going to be very important. If the number actually comes in stronger than expectation, then you will actually see a major sell-off in the US market. For those who follow US market, you notice that over the last 4 days, be it Dow Jones or Nasdaq, they've been gaining 4 days in a row on expectation that tonight the CPI December number will actually come in milder than expectation. But we will just have to see 9:30, halfway through our seminar. Okay. Having said that, there are at least 2 silver linings that I can actually tell you. Number one, I'm sure you know about the reopening of China 2 weeks ago. This is going to be very positive to Malaysia and whole world in general. But of course, there are concerns over whether the sudden surge in cases, whether the Chinese government can actually handle it. We were very worried about 1 or 2 weeks ago. There were a lot of horrible reports suggesting that cases in the millions on a daily basis, and funeral houses were actually piled up with bodies. But over the last 1 week or so, or over the last couple of days, you notice that the news on China COVID infection has actually died down. So we can only assume that they are actually handling the situation. Put it this way, I mean, if you look at the experience in other parts of the world, India or the US or Europe, yes, you can't avoid a sudden surge in cases, but after the strong wave, normally it will actually taper down. And again, as equity investors, we are more inclined to look beyond the peak of the infection, and hopefully Chinese economy would actually normalize after the big wave hit them, as what is happening right now. This is very important because there is a slowdown in the US as well as Europe. You need China to come back into the international market to buy up natural resources, to buy up manufactured goods, even services. They need to fill up the gaps left by the US as well as Europe. And for Malaysia, you'll be surprised. China is actually a bigger trading partner to Malaysia as compared to US. China, you're talking about 16%, whereas US only 11%. So, and of course, Malaysia's tourism industry depends a lot on Chinese tourists. And if you look at the stock markets, some of the stock already reacting to that. For instance, your MHB share price have actually gone up quite a fair bit over the last 1 to 2 weeks. Moving on to second silver lining, those who follow US dollar, you notice that the currency actually peaked about 2 months ago. This is actually a very good news to EM, i.e. emerging markets like Malaysia, because when your US dollar is too strong, there is less incentive for international investors to come to emerging market and take on too much risk, because they will actually suffer from currency translation as well. But now the US dollar has peaked, meaning that the EM currency would not actually depreciate anymore. Chances are they will actually be appreciating. So that's when the risk of investing in EM will become a lot less. So money will actually be going back to EM equities as well as EM bonds. And the other thing is that if you look at the top chart, that basically what happened during 2018, 2019, when the Fed raised rates. And the bars basically show you the money flowing in out of emerging market. So if you can look at the chart, when the Fed was actually raising rates, you see outflows from emerging market equities, meaning that international investors are actually selling off EM shares. But as and when the rates peaked, you can see that in the second part of the chart, the money started to come back to emerging market again. So we are pretty much at this point because just now, I spoke about the rate hikes in the US to peak in March at 5%. So we are almost there already. It's already at the tail end of the US rate hike cycle. So for that reason, there is a strong likelihood that the money will start to flow back to emerging market again. And Malaysia, we are in a sweet spot. Why is that? If you look at the table at the bottom, it's basically showing you the weighting of all the EM countries in the index. Of course, China is the big brother. They command more than 30%. But I want you to focus on Malaysia. 18 months ago, in July 2021, our weighting was actually at 1.24, right? And right now, December 2022, the weighting actually increased to 1.52. Even though it's a small change, it can translate to very big difference in M index, MSCI is all right. Why Malaysia's weighting is actually going up over the last 18 months. In fact, this is the first time ever in many, many years that we are actually seeing our weighting in the index increasing. Reason why in the past our weighting was falling is mainly because of our big brother China, who was like taking weighting away from everybody else in the index. But towards middle of 2021, people are starting to get worried about the Chinese government's crackdown on a few sectors, for instance, education, for instance, tech sector. There was also a property debt crisis in China. And also, I think increasingly people are worried about Xi Jinping's administration becoming more and more authoritarian. So foreign fund managers are starting to leave China. That will actually affect their weighting in the index as well. And secondly, globally, one trend we can actually see right now is that money is actually moving away from tech and growth stocks back to values dominated by value stock, like your plantation, like your banks, the more boring brick and butter, brick and mortar kind of businesses. But this is actually a good thing because, as I mentioned, the money is actually flowing out from tech and growth stocks back to value stock. So we are benefiting. And of course, Russia, when they invaded Ukraine many months ago, the MSCI immediately kicked them out from the index. And prior to them being kicked out from the index, they actually commanded about more than 3% weighting in the index. So this weighting had been redistributed amongst the EM countries in the index. And also, lastly, as you all know, we have a new prime minister. And the expectation is that this new prime minister will be more friendly to foreign capital, be it short-term, hot money if you like, or long-term. And we wouldn't be surprised once he has settled in, he will start to go on an international roadshow to try and entice and attract investors back to Malaysia. I think he realizes that foreign money is very important to our economy as well as stock market. You want your economy, your stock market to be vibrant, you need participation from the foreign investors. I mean, those who are investing in stock market during the 80s and 90s, you can actually tell how the foreign flow can actually make the big difference in our stock market. As a side point, I mean, right now we are doing an online kind of a seminar. I mean, when I'm doing a physical kind of seminar back in those days, I love to also tell the audience, during the good 80s, 90s, our Malaysia's weighting in the index was actually 33.6%. Now we are 1.5. Can you imagine that? Of course, for those, again, who remember what happened during Asian financial crisis in 1998, the moment we implemented capital control, we were a bit like Russia, we were being kicked out altogether from the index because if you have capital control in place, your country become uninvestable. That's when our weighting actually fell to zero. But over time, when the capital control was lifted, that's when we started to regain our weighting in the index. Unfortunately, by that time, China was already coming. So basically, it's taking away all the weighting from Malaysia, as well as some of the EM countries like Brazil. So coming back to the thing I wanted to say, when I was actually conducting all this physical seminar in some of the smaller towns in Malaysia, I love to ask the audience, show of hand, who thinks the bull market will actually come back to Malaysia, like in the 80s, in the 90s. Most of the time, I can actually see a few hands, but then I will actually tell them it's just not possible. Why is that? Because those days, our weighting is more than 30%. So foreigners, whether they like Tun M or they don't like Tun M, they still need to put money in Malaysia. But this day, our weighting is only 1.5. So if you're hoping that the kind of bull market in the 80s and 90s can actually come back to Malaysia again, unfortunately, it's just impossible without having a very big weighting in MSCI EM index. A side point also, during those days, when Malaysia commanding more than 30% weighting in the index, Mark Morbius, the specialist, the botak guy the specialist in emerging market, when he came over to Malaysia to do company visit, right? He actually stayed in Malaysia for 10 days, He was like seeing so many companies. He even bought a house in Johor, I believe. But of course, now his focus is pretty much on India, for those who also follow his interview on YouTube or even in CNBC and Bloomberg Network. Okay, coming back to second part of our strategy, i.e. amidst all these macro headwinds, potentially US slipping into the recession, I think over the next 3 to 6 months, you have to invest very carefully. You have to look for sectors and companies that can actually give you very strong earnings resilience. So step number one is that you want to avoid exporters, because exporters would be hit by the slowdown in the global economy. So you want to focus on companies of which earnings are driven by domestic consumption. And these are the sectors that you should be focusing on. We see strong earnings resilience in banks, in telcos, in automakers, in retailers, as well as construction companies. Starting with banks, we were compiling the earnings for the sector the other day, and it actually quite surprising to me, even for someone who is actually following the market very closely, that the earnings growth turned out to be low 20s, which is very, very significant. But of course, partly that was because of low base in 2022. If you still remember, there was this Cukai Makmur. But even if you are to take out the Cukai Makmur, you are still talking about banks growing their earnings in the low teens. Very, very material and significant. Why? Because banks are very big companies and they are very large cap companies. In order to grow 11%, it's definitely not easy, but they can actually do it this year based on our forecast. Why is that? There's still decent loans growth, and they also need to make less COVID-related provision. In fact, they may even be starting to write back some of the COVID provision they made during COVID years over the last 2 years. So bank earnings would actually anchor the Bursa's, the whole corporate Malaysia's earnings in 2023. The other sector we quite like is telco. Even though the share price have actually recovered quite a fair bit, I think a lot of telco stocks are still trading at very low valuation. I think 3 months ago, when I was going around talking to some of the institutional investors, at that point, Maxis was trading at 3 ringgit, I think 3.20. It is a level that I have not seen my whole life, I would say. But of course, right now, it has actually recovered to 3.80. I think the reason for the very bad performance of telco stock over the last 2 years is because investors do not quite like the terms of the rollout of 5G in Malaysia. You know that how we're going to roll out 5G is to rely on a government SPV called DNB, Digital National Berhad. We are using a model called single wholesale network, meaning that there's only one government-led organization is going to put in the 5G infra, and all the telcos will have to lease bandwidth from this DNB. So investors are worried that, without competition, whether DNB is going to overcharge the telcos, and for that reason, it will actually eat into telcos margin, so on and so forth. But right now, you have a new unity government led by PH, and if you go back to what Anwar actually said while he was still opposition leader back in 2021, he himself doesn't quite like this single wholesale network model because, as you know, left-leaning government, i.e. PH, they are more prone to competition. They don't like monopoly. So I think SWN struck them as another monopolistic kind of government company. So they may actually modify their terms with regards to the 5G rollout, and that could potentially be resulting in a major re-rating for the telco sector. Having said that, even without that re-rating, I think telco earnings will be very strong. Right now, basically, you're doing a lot of things on your smartphone. Without your smartphone, you basically cannot leave. You're working, through the smartphone, in your Zoom meeting, you're ordering food, you're doing online shopping, you're streaming your movies. So whether it's inflation, whether it's recession, you will still hang on to your phone. So for the next 3 months, as I mentioned just now, the global economic outlook is certainly not very clear. So if you own telcos, is a very good place for you to hide, if you like. And over the next 1 or 2 months, I believe a lot of institutional funds will start to realize the kind of risk they are facing themselves. And I think they may actually look at the telco stock again to reinvest. One very good observation is 3 months ago, when I was going around to meet up with all these institutional investors, we actually started to promote telcos to them, but the response was not so great. But this time around, in fact, we are in the middle of our roadshow. They are definitely a lot more receptive to telco. So I think it's good time to really look at telco stocks like your DG, like your Maxis. Yeah, they can actually give you very good upside potential, and downside is pretty much protected, if you like. Auto is one of the sectors that we quite like. We've been tracking this motor, they call it TIV, total industry volume, meaning that how many cars were actually delivered to the buyers on a monthly basis. And we also check another number which is called the industry outstanding bookings, meaning that you place a booking for your car, but you may have to wait a couple of months before you get your car. That number is actually even more interesting. Why is that? Because in the month of September and October 2022, the number is actually unchanged at 350,000 units, meaning there are still 350,000 bookings, waiting for deliveries. I think a couple of months ago, prior to that, you are talking about 400,000. You remember during COVID, there was this SST exemption, and people just were buying car like there's no tomorrow. That's how we got that 400,000 outstanding bookings. But of course, over the months in 2022, the number kind of like falling because the vehicles were actually delivered. But then coming back to what I said just now, in the month of September and October last year, the number actually stopped falling. It was actually remained unchanged at 350,000, which means, whatever deliveries were fully replenished with new bookings. So even without the SST exemption, Malaysian are still buying new cars. So this is actually good news, which means that the earnings of motor companies or auto companies will be very, very strong over the next 9 to 12 months from now. I actually can give you a bit more stock picks later on. We also like retailers. Basically, it's consumer, but for consumer sector, our focus is pretty much on retailers rather than food producers or processors. Meaning that we like Aeon, we like My News, but we are a bit concerned over F&N, Nestle. Why is that? Because retailers, they are actually benefiting from the so-called revenge shopping by the consumer. However, the food producers like F&N, like Nestle, they are actually having a bit of problem passing on the higher cost of soft commodity to the end users. One thing is that retailers like Aeon, their main customers are actually M40 groups. M40 groups meaning the middle income group. They still have a lot of savings. Their household balance sheet is actually quite good, so they can actually continue to spend despite the high inflation. But B40, they are a lot more vulnerable to inflation because this inflation is basically eating into their spending power. And for that reason, the F&N and Nestle of the world, they dare not raise prices enough to pass on the full increase in soft commodity prices to the end user, worrying that people will actually cut back on spending. So for that reason, retailers' margins are quite strong, whereas food producers, their margins are being eroded. Construction, we actually quite bullish on the sector just right before the election, because at that point of time, people were thinking that BN was going to win big, and they're going to roll out all these public infrastructure projects. But of course, what was the outcome of the election. But it doesn't really matter, because the unity government led by PH will still be rolling out public projects, but the timing will be a bit delayed, because right now, I think the focus is pretty much to, review some of these big contracts being awarded by the previous administration. After they've done this, they would actually start rolling out the new public projects, especially MRT3. I think they would definitely do that. Why is that? Because you need all these public projects to pump right the economy, to shield the domestic economy from the slowdown in the external sector. So maybe towards the end of first half, that's when I think you should actually relook at construction companies ahead of new contracts being awarded by the government. Okay. The Outlook presentation wouldn't be complete without talking a bit on politics, but just to give you a broad idea as to what are the investors' concern. Right now, as you know, we have a unity government with more than 2/3 majority, but they are concerned over what will happen after the UMNO election, which is supposed to be held about 4 or 5 months from now. If there is a significant change in the balance of power in UMNO, whether the 30 blue dots on your left-hand side may actually leave the unity government. So that is a concern, and it's a valid concern. But we believe, or we take comfort that PH they now control 82 seats, as long as GPS is to stay. 82 plus 23, you get 105. Okay, so which means you only need 7 out of the 13 green dots on your right-hand side. These are mainly parties based in Sabah. You only need 7 of those green dots to give you the threshold 112. So for that reason, I think even without BN, I think the unity government can still survive. But I think right now, the focus of the market is not so much on the stability of the unity government. I think the market kind of like assume this unity government would actually last. I think their main concern, or the main thing they want to know, is what to expect in February 24th, when Anwar Ibrahim is going to announce the revised budget. So right now, what I'm trying to say is that the market is trying to put aside the political risk and they basically work on the basis that this unity government would actually last. Of course, when we talk to our investors, some are a bit concerned over some of the new policies being rolled out by the new unity government. As you know, as you would have followed, they cut the draw days for NFOs. Some people are not very happy. And then they actually highlighted that the rice import in Malaysia is dominated by one party, and they're asking that party to do something about rates. And then midnight, 1st January, you remember there's no firework display by Petronas. To me, it's pretty much symbolic, but that is also, they want to send out a message that we want to be prudent with our financial. And if you remember also in December, the new communication and digital minister, Fahmi, actually came out to ask telco to cut prices again. If you recall, in 2018, Gobind Singh asked telco to cut their rates by half. And that's when TM, if you remember, fell to 2 ringgit. So market was a bit worried about this more left-leaning government to actually roll out some of the policies which are too consumer as compared to pro-business. But the saving grace is that then we actually knew that in the end, what FAMI actually announced was telco, they actually came out with a special package for the B40 group where you spend 30 ringgits, you get 6 months of data subscription. So yeah, no big deal. So which means that the knee-jerk reaction when he announced this in December, if you remember that day, CI actually dropped quite significantly because all the telco stock went down. In the end, it turned out to be a non-event. But then, as investors, you still have to be very mentally prepared. Let's say for any potential more left-leaning kind of policy being implemented. But before that, I think we take comfort that this is not a pure left-leaning government. This is a unity government where you also have partners from the right-hand side, i.e. BN and as well as GPS is pretty much right-leaning kind of parties. So you have check and balance within the unity government. But assuming some of these left-leaning policy are to be rolled out, then the market will get a bit worried. Say, for instance, if we are opening up our economy for foreign competition a little bit too fast, then you may have a bit of slowdown on some of the listed sectors on Bursa Malaysia. And pro-consumer, if they are pro-consumer policy being rolled out, like for instance, the government asking telco to cut prices, the consumer would actually benefit, but the corporate would actually be suffering in terms of profitability. That's what you saw in 2018 back then when, like I said, TM share price actually went down to 2 ringgit. And I think the current government is more prone towards smaller GLCs because, our economy is very dominantly controlled by GLCs. It's not to say that is a bad thing, but just that GLCs are always being perceived to be monopolistic in their business model. So that actually killing off competition, which is not so good for consumers, as well as bringing up our sectors and company to the next level. I mean, if you are so protected in your domestic market, it can be jago kampong, but if you are not so used to competition, you can never be a global champion. So that's why we think left-leaning government, they kind of knows this. Maybe over time they want to reduce the GLC's role in the economy. Fiscal prudence, I actually mentioned that if we are to cut back on spending, the government is to cut back on spending, it's going to affect sectors which are relying on government contracts. I think construction is one of them. Fiscal prudence by itself is actually not a bad thing, but it will actually ensure long-term financial sustainability. But if they do it too abruptly, it's not going to be too good for the market as well. And the other thing is that left-leaning government is more prone towards free market economy model that do not quite like too many subsidies because that would actually distort the allocation of resources within the economy. They're already talking about more targeted subsidies, especially for petrol. But again, I think they also realize that right now the inflation is still kind of high. So they are not going to, pull this back abruptly and affecting consumers' spending. Lastly, GST. GST, strictly speaking, has nothing to do with your political inclination, whether you are left-leaning or right-leaning, nothing. But we put it down here mainly because, assuming PH is more left-leaning, and then if you remember back then in 2018, the abolishing GST was one of their election promises. So I think they also realized that it's very important to introduce some form of consumption tax in the economy and to help to broaden the tax revenue base of the country. I think they fully understand that, but they may not actually introduce it immediately because after all, in 2018, they were against this GST. I think give it 12 months. After that, maybe they will do something. They will introduce something like GST. They can call it VAT or whatever acronym they like. But the end result is that we need to broaden our consumption taxes. For those who follow news also, it's quite interesting. I think last week, FMM came out to propose to the government to reintroduce GST at 4%. Okay, FMM, Federation of Manufacturers of Malaysia. Of course, what they are arguing is that yes, you can actually bring back GST, but on the other hand, maybe you want to reduce your corporate tax rates as well as your personal tax rates. Okay, coming back to talk about sectors again. I think I highlighted most of the sectors we like just now. Just to add on to the list, we also like building material. There are two key stocks there, P Metal, which I believe you are very familiar with. Valuation is definitely not cheap in terms of PE, but we think P Metal is a very good ESG play. And they are also China's reopening play, given the fact that aluminum prices have actually gone up a bit. In fact, all commodity prices have actually gone up after the reopening. So this will actually be translating to better profits for P Metal. We also like another company called OM Material, which are basically doing or making ferrosilicon as well as manganese in Samalaju in Sarawak. They are going to be benefiting from very firm ferrosilicon and manganese prices, mainly because the supply of this material, which are actually used in steel making, is very tight in the global market right now, partly because of the war and partly because of the supply chain disruptions. Okay, going down the list, gaming, we are positive on casino operators. I think they did disappoint in terms of earnings over the last 2 quarters. I think market expectations were kind of like unrealistic because at that point in time, the reopening was only partial. But I think in coming quarters, they're definitely going to show much stronger numbers. So we do have buy for Genting as well as Genting Malaysia. As you know, as the international borders reopen, you will actually be seeing more Chinese tourists coming back to the casino as well. Oil and gas, we are positive. We are looking at oil prices of $80 per barrel. At $80 per barrel is a level of which oil majors are more than happy to spend on capex. When they start spending on capex, including Petronas, then it will actually result in a lot of jobs for our service provider in the market. Some of the names I think you are very familiar with, Armada, Dayang, Valestor, as well as Usma, which I will talk a bit more later on. Private healthcare, we like IHH as well as KPJ. I mean, if you happen to be in one of the private hospitals in town during the weekend, you can actually see how heavy is the traffic, because a lot of people basically postpone their elective surgeries, meaning the less urgent ones during the COVID period. Now they're coming back to do these elective surgeries. And also, I mean, if you happen to be, getting some services from private hospital, you know that the raise prices, like, there's no tomorrow. And yet, you're happily settling the bill, mainly because medical services, they have a very strong pricing power. They can effectively pass on all the higher costs to the end user. Not like I mentioned just now, food producers, because their target customers are actually B40. So, they have to partially absorb all these higher costs. Okay, utilities is basically Kenanga. I think for those who really follow Kenanga, you notice that there's a certain mechanism that would actually pass on the higher fuel costs back to the government. ICPT is called. Problem is government was kind of like very tight in cash flow, so that amount was actually snowballing, especially over 2022. So people are getting a bit concerned. They call it actually under recovery of fuel costs. So that amount actually ballooned to a very large number. Market got worried. That's why Kenanga got sold down, especially during the first half of 2022. But thereafter, government started to, to pay up bit by bit. So that's when Kenanga share price started to recover. I think our view is very simple. The government is going to settle the full amount of whatever they owe Kenanga, no doubt about it. And also the other thing is that you can actually tie back what I said just now with regards to money flowing back to emerging markets, including Malaysia. Kenanga commands a very heavy weighting in FPM 30. I think used to be low teens, now probably in the high single digit. So yeah, when all this foreign money starts to come back to Malaysia, whether they like Kenanga or not, they will have to buy, because Kenanga is a very heavily weighted kind of index stock. Okay, let me see. Okay, we already talked about 45 minutes, so I try to keep to the timing. Okay, the sectors which we are not too gung-ho at this point is aviation. Yes, MHB definitely going to be benefiting from Chinese tourists. But if you remember, end of last year, even during the PN government, a decision has been made, i.e. not to raise airport taxes. So this is actually not too good for MHB, given the fact that your operating cost is actually going up. The other thing is AirAsia. We are still concerned over AirAsia's balance sheet. Now it's called Capital Air, as you know. But surely share price actually moved up quite significantly from 60 cents to 70 cents over the last 1 month or so because of China reopening play. But I think if you want to buy Capital Air, you have to be fully aware that there are still a PN company, and then PN 70 company, and then they may just need to raise more funds in order to pep up their balance sheet. Media companies like Media Chinese, Media Prima, even Astro, they are not so exciting right now because they are struggling to transform from traditional to digital kind of platform. Plantation, we actually quite like the sector, but unfortunately, share price are not going anywhere because there's not so much re-rating catalyst over the immediate term. The CPU prices, we are actually looking at 3,800 for 2023, which is lower than 4,005 you got in 2022. But at the same time, at 3,800 actually is quite profitable for plantation business. But unfortunately, at the same time, your production cost is also going up, especially fertilizers. So net, I think plantation is still a very cash generative kind of business. The only thing is that with CPU prices, significantly lower than what you saw the peak during 2022, investors are just not getting too excited over plantation at this point in time. Plastic and packaging, these are mostly the plastic maker like Tongguan, SLP. We are not too positive at this point, mainly because these guys, 80% of their product are actually exported to Europe as well as Japan. They are going to be suffering because of the slowdown in the global economy. Property, I think you noticed that one of our competitors actually upgraded the sector recently, which we don't think, we think it's a bit premature for for a very strong, for a very simple reason, i.e. your mortgage rate is actually going up. And at the same time, your construction cost is also going up. So that is going to hurt your affordability, meaning that, homes can become a lot less affordable to some of the lower income group. So definitely not the time to upgrade the sector. Yes, I understand that the sector has been in a doldrum for the longest time. For those who follow the sector, you remember it peaked during 2014. That's when also the oil and gas sector peaked. Thereafter, both the sector actually crashed. But oil and gas already came back, but property is still lagging. I think I don't think we have seen the light at the end of the tunnel as yet for property sector. REITs actually give you a stable yield, 5%, 6%. But again, because if you can get about 4% from FD this day, REITs become less attractive because REITs is not risk-free. Things can go wrong, shopping mall occupancy can drop for whatever reason. So for that additional 1-2 percentage point you are getting from REITs, it's just not worthwhile, I think, at this moment. Seaport and logistics, as you know, because of the slowdown in Europe as well as US, global trade is actually slowing. So this is not too positive for ports as well as logistic companies. Technology, EMS, it is a hot sector back in 2022 before the sharp correction in Nasdaq. Share prices have come down quite significantly. So we did get questions from investors whether it's good time to position ourselves for tech stock again. We think maybe it's a bit too early, mainly because right now the chip sector is still undergoing inventory adjustment, meaning that the end users, they are carrying quite a fair bit of stock and they have no intention to actually order for new stocks. At the same time, the product demand for the product are slowing. So you have actually inventory built up all over the place. You would have to take a while before this thing can actually go away. But we do have certain names, not quite in the chip sector that we like, but it's in the technology sector, KGB, as well as LGMS, which I may talk a bit more later on. Hopefully, if I can actually keep to my timeline. Tobacco breweries, pretty much like REITs. Again, because of 4% you can actually get from your FD. Tobacco brewery, maybe I give you 6-7%, but for that additional 2-3%, given the kind of risk, regulatory risk, suddenly government said kids are not allowed to even consume cigarettes going forward. Those kind of things, it will actually hurt your share price. So it's risk that not worthwhile taking. Gloves, the major outperformer during COVID days. Unfortunately, even after share prices come down by 90%, there's still no investment case for this sector. I think we did get question as to why you want to call a sell on a stock that has gone down by 92%, right? It doesn't make sense. But the thing is that even at the current level, the valuation is not attractive. They are not profitable. That's number one. So there's no PE to talk about. Then next, you look at their asset value, right? Book value. Okay. I think 2 out of the 4 big glove stocks are still trading at a premium to their book value. Then you say, why not? But then you have to look behind what are the assets. What is the book value? 2 things. Number 1, they have machine. Number 2, they actually accumulated quite a fair bit of cash during good times. And their plant, their machine, they are basically running at 30% utilization at this point in time. So when your asset is only 30% utilized, unfortunately, you have to take a discount. Then you say, oh, what about cash? Cash is cash. You cannot take a discount on cash. But the reality is that these companies are actually making losses. I think it's not only like P&L losses. It could even be cash losses, meaning that they're also burning their cash because the prices are so bad. Just to give you an idea, to produce 1,000 pieces of glove, your cost is $20 to 22. Okay, 20 to 22. And you know what kind of prices they're selling right now is $20 per 1,000 pieces. And what kind of prices the Chinese producers are selling? They are selling at $15 per 1,000 pieces. So that's why during the surge in COVID cases in China, nobody actually got orders from China because they themselves are producing so many gloves and they're selling at $15 per 1,000 pieces, whereas we are selling at 20, right? Okay, coming back to our topics. Our overall topics, we put a lot of banks there. Maybank, CIMB, as well as ABNB is basically Alliance Bank. We like these three banks. For telco, we like DG because they are the market leader right now after the merger with Celcom. Plantation, a sector we like, but we don't want too much exposure at this point of time. But we still want to own KLK, which is the big brother of Plantation stock. Gamuda would be our preferred construction company. Why is that? While waiting for the MRT3 project to get off the ground, they are already securing quite a number of overseas jobs, especially from Australia. So good sign. Oil and gas, we have a funky pick here, Armada, for institutional investors, especially. They lost so much money that they're basically happy to forget about this stock. And but we think the company has turned around. Previously, they had a bit of issue with their balance sheet, but they already paid down quite a fair bit of their borrowings. So you can actually say that they have managed to restore their financial health. And what's so interesting is that the market has not actually priced in the possibility of them getting new contracts. Whereas for other bigger boys, like for instance, Inson, it is almost an open secret that they are going to get contracts. So the market effectively has actually priced in these so-called surprises. But for Armada, it's not the case because Insti clients, they are not actually following this stock very closely. And some of them could have written off the stock altogether. But then, like what I said just now, they have managed to restore their financial health. And the market for oil and gas service out there is very tight. Everybody got their orders already. This is one of the few guys who still has capacity. So when eventually they get a major contract, that's when your share price will actually re-rate up significantly. For auto stock, we like the auto mainly because we like their Mazda franchise. Mazda is a mid-market kind of vehicle, but they are actually more expensive than their competitors. They are always being perceived in Malaysia as a premium mid-market kind of vehicle, so that P Auto can actually make much better margins as compared to its competitors. For retailers, we like Aeon and MyNews. I mean, you can actually see the footfall, the traffic improving after the economy actually reopened. And the coming year, they are going to benefit from the full year impact of the economy reopening. So share price can actually really perform. I think those who bought MyNews, you realize that share price almost doubled already. At the low, it was at 41 cents. That's when they deliver a very strong, I remember it's actually third quarter results. That's when we actually upgraded. So share has actually performed very, very nicely. I'm not quite sure any of you actually follow Sharia, but for our Sharia topics that we actually recommend to our institutional investors, we basically took out the banks and replaced it with a lot of telco names like Maxis, TM, as well as OCK. OCK is a telco tower operators. We also like CTOS because after listing, share price has come down quite a fair bit already. So it has become less expensive. Okay, I think I still have about 15 minutes to in my presentation. Maybe I just go through very quickly some of the names we like within the sectors. Okay, for auto, we like MBM, MBMR, mainly because they are the proxy to Perodua. I believe some of the new models, the waiting period right now is actually more than 1 year. So yeah, talking about very good earnings visibility. I think both the stock MBMR and B Auto, they also pay very decent dividend of more than 6%. So these are two auto stock you want to take a look. Banks, I think I pretty much done there. Our picks are Maybank, mainly because you are getting your 9% dividend yield. I know share price is not really moving that much, but I think 9% is a very decent kind of return for, this kind of safe stock that you can actually, buy it and sleep at night. CIMB, we like it because it is one of the names that the foreign fund would actually love to own when they come back to the market, apart from what is being shown there. So there is it is a bit like a high beta banking stock. Like Alliance actually gone up quite a fair bit, but the value is still there, mainly because if for those who are familiar with financial ratio, their ROE, return on equity, is actually 11%. Dividend yield is 6%, is as good as some of the bigger names in town. So that's why we still like it. We talk about this one, P Metal and OM Material. Construction, we talk about Pamuda. A consumer, yeah, I talked about that already. Gaming sector, we like Genting. Basically, is the reopening play. Spot Toto is pretty much for your 8% yield. Oil and gas, for big cap, we actually recommend PCAM. The PE valuation has become quite cheap, mainly because you see the end product is actually chemicals, petrochemicals, and the prices have actually come off in line with oil prices. But at the current level, they are still highly profitable. A bit like the plantation situation where people expect prices to come off the peak and then they don't show a lot of interest. But in terms of valuation, it's actually quite decent. Right now, it's actually trading at 10 times. Well, prior to pandemic, it was actually trading at 15 times. So value is definitely there. So you can actually look at PCAM. Amada is our small cap pick. Healthcare, we like IHH because of private hospital. We also like Cotra. This is an interesting pharmaceutical company. Their biggest brand is actually Abaton. I mean, even personally, I thought Abaton was a foreign brand, but only recently I found it's actually a local brand. They invested quite a lot in this brand during the initial years. Now they are actually recouping their investment, in the sense that people are already very familiar with the brand and they're willing to pay a premium to their product. So that's why their earnings are actually coming through. MGRC, this one is quite interesting. They're actually doing DNA sequencing previously, but right now they're actually expanded into what they call immunotherapy. It's a new therapy for cancer patient. I think it was a very expensive treatment for those who, for the package coming from Europe. But MGRC managed to get similar thing from China, which is equally effective, but the price is just a fraction of what the European are charging. That's why this business segment is actually growing very rapidly. In fact, they have exclusive right to distribute that Chinese-based immunotherapy product in the regional markets as well. So this is one of the stock you want to watch. Cocoa, we talk about that. Utilities, Kenanga, we talk about that as well. Aviation, we don't like both airport as well as capital air. Media, if you want to buy something, maybe Media Prima is our pick because they do have a certain digital business within their portfolio. Plantation Peak is KLK, as I mentioned. And for plastic and packaging, I think if you want to buy one, that would be Tongguan. For property stocks, we go for the more defensive ones, which are, to a certain extent, they have also some overseas exposure, of which are doing quite well, especially for IOI properties. Ecower, I think a very strong brand, and they still managed to actually record very good sales despite the very soft market condition right now. REITs, yeah, if you want to buy one, that will be Pavilion REITs, mainly because of the very strategic asset, i.e. your Pavilion shopping mall, and they will actually be benefiting from the return of the international tourists. Seaport, we like Bport because Bport is not so much subject to the global trade slowdown. They are specialists in handling the LNG from MLNG in Sabah. Shift is a domestic logistic company, warehousing as well as integrated logistic services within Malaysia. They are actually benefiting from the booming, as you know, e-commerce market in Malaysia. Technology, okay, this one maybe I spend a bit more time. KGB, basically a contractor to fabrication, chip fabrication plants. A lot of chip makers are actually expanding their plants right now, even though, you know, as I mentioned now, the sector is undergoing an inventory adjustment. They are basically investing for the future, and KGB is one of the contractors for all this wafer plant expansion. They are basically announcing new contracts every few weeks, so they're actually doing okay. The only thing is that the only complaints from some of our institutional investors is that the share price did not quite come down that much now, despite the correction in tech sector. So, you know, when share prices come down, you know what to do for KGB. LGMS, this is a ACE listed company. They are actually specialists in cyber security. Basically, their business model is they provide hacking service. Okay, you could be like scratching your head. Why people hire these people to hack their system? Actually, the whole idea is to hire them to hack and see how secure is your system. And over time, I think this has become one of the SOP for most companies with you know, digital presence. So their business is actually expanding very nicely. So this is these are the two tech stocks which are not chip related that you can actually look at it. Bluff, no recommendation at all. All right. Okay, I think about that. Just 5 minutes short. Maybe I open the floor for question.
Thank you so much, Joshua, for sharing with us where are the investment opportunities for the year 2023 and what are the sectors that have earnings resilience. So if you have any questions to ask the head of research of Kenanga, please write your questions in the Q&A box so we can address them accordingly. We have about 20 minutes for question and answer. All right, the first question is asked by GLTO. So, Mr. Joshua, so the question here is, so far, the Bursa still see continuous foreign outflow. So why is
Mhm.
that so?
Okay. Yes. Last year was actually not so bad. We were just talking during over lunch this afternoon. For those who track the foreign inflow and outflow from Malaysia, last year we peaked at about 8 billion, but we closed the year at only about 4 billion. That has a lot to do with expectation on ringgit direction during early part of the year. So initially, the market did not quite expect US to raise rate that aggressively. So as and when the Fed started to raise 75 basis point a few times, the EM currency actually dropped. That's when foreign money, they decided to take the money and left. But again, not too bad, because considering the fact that I think in recent year we saw more than like 10 billion outflow during a single year, but last year is up 4 billion. And going forward, I think if you ask me the direction of foreign funds, like I explained to you just now, the chances of them coming back is actually quite strong. I'm actually tracking money flowing out of or flowing it out and in of EM on a weekly basis. There are some very, very good numbers that I actually keep track of. You can actually sense that money is starting to go back to emerging market for the reason I highlighted to you just now. And of course, right now with even though US have not quite hit the peak rate as yet, but US dollar is already started to weaken. So I think that the flow out of EM or Malaysia would definitely slow down. But of course, in the final week, I think there was a massive outflow. That one can't be helped because it's part and parcel of their year-end rebalancing. But looking at New Year, I do believe that money will start to come back to Malaysia and EM as a whole. And hopefully our new Prime Minister will do something about it to bring back foreign investors. Actually, the other point I forgot to mention just now, for those who keep track of the market volume, our market is dominated by retail investors and institutional investors. And you see the foreign participation is so low, it's like 10%, 15%, not even 20%. This is not so healthy for a open economy like Malaysia. Hopefully things will change with a new administration.
All right, thank you so much, Joshua, for your clarification. I've seen a couple of questions on public bank. So could you give us your view on this bank, since that banking sector is one that you are overweight on?
Okay, public bank in terms of valuation is definitely kind of like fully valued. But of course, the reason why the stock is fully valued is because people like its stability. It pays dividend, but not so generous as compared to Maybank. There are concerns over after the passing of the founder, whether there will be major changes in the shareholding of the bank. But we are not too concerned because there's a bank negara rule that no one single individual can hold more than 10% stake in a bank. The management of the bank will be intact. I think the founder, I believe, had not been very well in recent years as well. He had actually left the day-to-day running of the bank to his successors for the longest time. They know what to do, not to worry. Earnings are actually quite strong. But unfortunately, this stock is kind of like low beta. You can buy the stock for dividend, and maybe when stock market is a lot better, it may go up 10 cents, 20 cents. When stock market is a little bit less interesting, then it will drop 10-20%. So it is a good stock that would help to anchor your portfolio. So if you have a portfolio of stocks, yes, you can actually buy some public bank. At the same time, you want to buy some higher beta stock as well to give you that stability. I think the same formula actually works for fund managers as well. That's why they do own public banks, even though it's not so exciting.
All right. Thank you so much for your sharing. The next question is by Lim. So between Genting Berhad and Genting Malaysia, which company offers a better investment merit?
Okay, depending very much on your risk appetite, I think the argument is that if you want to have a more diversified group, with plantation, with gaming, with other businesses, then you would actually go for Genting Berhad. If your focus is pretty much on the gaming side of the business, surely you want to buy Genting Malaysia. But at this point, I think both are going to be doing well. But what of caution is that there's this ESG thing, environmental governance, social, and a lot of funds, international funds, would no longer touch gaming stocks, no longer touch defense stocks, no longer touch brewery and cigarettes. So over time, you will actually be seeing derating of the stock because less and less people are chasing this stock. I think if you ask my opinion, the upside of all these non-ESG stock will be kept because a lot of big funds, they own this stock for years. And now, because they need to comply with the ESG standard, they are actually slowly disposing of their stake. If you ask me what would be the end game for all these gaming company, maybe eventually they will be taken private because given the trend towards ESG, there is less and less appetite for this kind of stock. Even these days, when foreign investors come in, they're no longer looking at gaming stock. Last time, these are one of those more popular stock they like to invest. And then they don't pronounce it at Genting. They say Genting. I want to buy Genting. So what is that?
Right. Thank you so much for sharing this. Let's go back to banking. There's one question to ask. What about M-Bank, which is not in your list? Do you have any view on this company?
Bank, we do have a buy as well. We do have a buy, but it's not our topics. I think the stock is still trading at a discount to book value. As you know, the share price has done very well last year. I think a few small cap names, your Affin, M-Bank, Alliance actually done very well. We do believe there's still upside to some of these small cap stocks because they're trading at a discount to book value. And there could potentially be M&A angle to M-Bank. We'll see if the consolidation of banking sector is to eventually happen. I think previously some of the theories suggest that because we want to wait for the political situation to stabilize before we embark on all these major banking sector consolidation. I'm not quite sure they are even relevant, but these are the theories out there.
All right. Would you be able to give some insights into Dutch Lady Malaysia? So that's the question by Prem.
All right. Dutch Lady, okay, our key concern is still their ability to pass on higher milk solids, wheats cost to the end consumer. Having said that, things have actually changed because all these soft commodity prices have actually come back down from that very crazy levels. So we do expect the margins to recover over the next 1 or 2 quarters. I believe we also have a buy for Dutch Lady, but again, right now we just worried what if commodity prices start to run again because of China reopening. So they would be suffering margin compression again. So for proxy to consumer sector, I think the safer bet would be retailers like we mentioned, Aeon, MyNews, instead of all these food producer where they cannot actually pass on higher costs. I think for Aeon, they have no issue to raise prices. People will still buy because people have not actually replenished their wardrobe over the last 2 years.
All right. So Joshua, you are overweight for the telco sector. So the next question is about Timecom. Do you cover this stock? And what is your view on
Thankfully,
this
we
company?
do not cover. I think not many houses actually cover the stock, mainly because the disclosure is not as great as compared to the other telcos. But I generally, this is a stock institutional investors are very bullish on, so it's a buy to me.
All right, thank you so much for sharing your perspective. So let's go on to questions that are more macro. So we have a couple of questions also on macroeconomy. In short, are you bullish about the local market until the American market hits the recession? So that's the question. So what should be the retail investor strategy? Should we hold on to the local companies even throughout the recession if it happens?
Right. Okay. First thing first, like what I recommended in my presentation, you want to hang on to companies and sector with strong earnings resilient. But if you are talking about the better timing to enter the market, my gut feeling is like this. For those who follow Hong Kong market, you realize that it hits a bottom at below 15,000 just recently and rebounded so strongly to 20 back to 20 again within a very short period of time. This is something they call capitulation, meaning that everybody give up, throw in towel, cut losses. That's when Hang Seng actually hit below 15,000. So after that, rumors started to come out about China reopening. Then the market rebounded. So I think for Hang Seng, they have actually seen the bottom. Unfortunately, for US market, Dow Jones, Nasdaq, for instance, or even Bursa Malaysia, my gut feeling is that this market have not quite seen the what I call capitulation. So, well, it can happen if you have very bad numbers coming out from US. Like I mentioned later, 9:30, I'm not quite sure the number came out already. If the number is actually not so great, then there could be sell-off. Yeah, I mean, people are tracking this number on a monthly basis. So, or for whatever reason, there is a big sell-off. People cut losses in a massive way. Basically, you weed out all the weak holders. That's when the market will actually come back stronger. So, although we do have end 2023 target of 1640, I would imagine it's not going to be straight line kind of rise to 1640. You may actually see lower before it starts to recover. So I think if you ask me, I would still love to see some sort of final sell-off before the market can actually come back stronger. But again, as equity investors, you can't be holding zero position, right? You still want to own something. Right now, our recommendation is to go for more defensive kind of sectors. But as and when the cycle turns, let's say inflation in US is under control and the Fed is starting to talk about cutting rates, maybe that's when you want to jump back to growth stock, your tech and your growth stock that actually give you much more upside. But right now, over the next 3-6 months especially, I think I would rather stick with the most defensive sector like the ones I recommended to you.
Well, doesn't cutting rate means that the recession is about to hit? That's when they are prepared to cut rates?
Okay, this time around it's a bit different. It's something that I haven't seen before as well. I mean, it's interesting because the Fed, the ECB are actually raising rates while the economy is actually slowing because you have inflation problem. So I think the rate cuts will happen when they see that inflation is pretty much under control. Because if your rates are remain elevated for too long a period, it's going to hurt your economy. I mean, everybody loves to have low rates, then asset prices will actually go up, borrowing costs will be cheap, business will be booming. But then if this resulted in high inflation, then you have no choice but to raise rates. So I think the scenario whereby the Fed will start to cut rates would depends very much on the how fast the inflation can actually be coming off right now.
Do you see this as a stagflation?
Good question. Nobody has the answer. We will have to see because we do not know whether this inflation is going to come down. You know, if it's going to be remaining stubbornly high over a prolonged period of time, yes, you would definitely be seeing stagflation for the whole global economy. That is one of the worst scenario you would want to see. I would rather see, you know, a recession and then, you know, the global economy just bounce back from it. Instead of dragging, you know, over a prolonged period of time with no growth and high inflation.
Yeah, I would agree. The next question is by Farid Rahman. Joshua, so when recession strikes Malaysia, would it be better to invest in gold or invest in top KLCI counters which give high dividend yield? So what would be your pick?
Okay. Recession, yes, it could be okay. Actually for recession, I think the strategy is to buy bonds and avoid equities. You also want to park quite a fair bit of your money in money markets. To buy gold, gold is a very different ball game altogether. Is pretty much a safe haven assets, but the problem is it is also affected by a lot more variables than we can actually monitor. So I think for a retail investors, I would rather make it simple, i.e., I tell myself how much bullets I want to save, how much cash I want to save right now. And when prices are coming off, you can never pinpoint the bottom of the share price. So if you like particular stock, if you think the fundamentals are correct, you can actually start averaging down. You'll be surprised. Big fund managers out there, that's the strategy they're using because they know for sure nobody can actually pinpoint the bottom. So yes, you average down, and as a mentor, then you go more aggressively. As to putting part of your portfolio under gold, under foreign currency, under Bitcoin, I think it can become too complicated and difficult to manage. I would think.
All right. So it seems that the US data has come out, inflation data has come down. It cools down to 6.5%.
Market rally.
The next question is, what do you think about the US dollar direction? Will it continue to weaken against MYR? And what would be your house estimated range?
Oh, actually, our house view is kind of aggressive. I think you can see it here, right? Yeah, we are one of the more aggressive one. We are looking at 4.11. In a way, we are kind of like implying that US may actually more inclined towards cutting rates towards the end of the year. This is actually not average. It's the year-end target of 4.11. I think consensus, you are talking about 4.3 around that level. In other words, I think we as far as ringgit weakness is concerned, we already peaked last year when it was like going down like nobody's business. I think for EM currency as a whole, we have all seen the worst for currency. I think looking forward, I think the expectation is that there could still be a bit of weakness, at least during the first and second quarter, because US is raising rates by 50 basis points, 75 basis points. Our Bank Negara is only raising by 25. You know that, right? I mean, the higher your OPR or your target rates, then the stronger your currency can be, because that's when people actually pump money in your currency to actually enjoy the yield. So we are not raising we are raising rates, but not as aggressively as compared to the Fed. That's why I think our ringgit will still more on the weaker side, maybe during first quarter and second quarter. But towards the third and fourth quarter, when the US rates already peak, expectation is that they're going to cut, then that's when our ringgit will start to strengthen. So we are looking at end this year 4.11%. 4.11 ringgit to $1 US.
Wow, 4.11. Hopefully it comes through.
Yeah, me too, Anish. So
All right. So what is your forecast for oil price? I'm sure that when
oil
it
price,
comes
yep.
to 4.11, you factor into the oil price forecast.
No, okay. Oil price we actually use US dollar. So in that sense, it's already been reflected now. So you have reflected a slightly weaker US dollar.
All right. Now, what is your view on the EV sector? It is one of the hot sectors that investors are looking at right now. Do you have what is your view on the sector, and what are any recommendation in terms of the EV related stocks?
Yeah, I think right now EV stocks is still pretty much a concept play lah. But I think at some point of time your solar also a concept play lah, because you know you may have to wait another 2-3 years for whoever is going to the sector to see earnings coming through. I don't think we have very meaningful EV stocks to buy at the moment. But again, it's a bit hard to be justified on a fundamental basis, on earnings basis. But as a concept play, yes, you can actually do that. You can buy, hoping that it will come into play. Then you can actually cash out.
All right.
Yep.
The next question is, why are the financial stocks in Singapore stable and rising compared to ours on Bursa Malaysia that seems to be overweight? So that's a question by
Unfortunately,
Albert.
we don't cover Singapore, so we don't have a view on this.
All right, thank you so
We are
much.
basically a local-centric broker.
The next question is by Steven. So, what do you think about Inari? I think recently Inari also faced the rumor that the Apple could be not outsourcing so much of our work to Broadcom. So what do you think about this company?
Okay. Is number one, I think for those who invested in Inari, it went to 450 and now came down to about 280 prior to the sell-off 2 days ago. I think the share price performance is pretty much in line with tech stock globally. I mean, you look at Tesla, it's actually down 70%. It's even worse than Inari. Okay, for what happened over the last 2 days is very simple. Like you mentioned, Shane, basically, Apple want to insource a lot of their parts. They are actually no longer buying certain parts from Broadcom because they are, from the others, Broadcom, because they have developed internally. But what Inari is actually doing is RF, radio frequency, is a lot complicated as compared to what they terminated from Broadcom. I think the one is more like Bluetooth related. But again, stock markets, when they see A, they will immediately jump to B and C. That's how stock market work. Stock market wants to be ahead of the curve. When Apple says that they are going to insource their parts, even though they are not taking the one Inari is actually making, but you have to raise the risk premium for the stock. That would actually result in lower stock valuation. So we actually downgraded our fair value this morning. One of the questions, which I think is quite relevant, is that someone actually posted a question to my tech analyst. So Mr. So and so, are you going to downgrade Inari every time Apple comes out with bad news? The answer is very simple. I think Inari is smart enough to know that they will also have to do something, i.e. they want to diversify their customer base. So assuming they can successfully diversify their customer base as well from Apple, given the fact that they know that Apple is actually pursuing more insourcing over time, then yeah, okay, because by then you would have lock in other customers to make sure that your product can actually sell. So as far as share price performance, I think all this tech stock is still pegged to what you can expect from Nasdaq. And Nasdaq, the key driver for share prices is actually the interest rates in the US. I also got one interesting question from a client recently. He was suggesting that why, if if US is to cut rates or third quarter or even fourth quarter, then shouldn't we be buying tech stock now? Because the moment US cut rates, the tech stock would all be running. See, the problem with that theory is that what if the Fed decide to prolong or to what if the rates are to remain high for longer, assuming inflation is not coming down? Then you could be jumping back into tech stock a bit too early. You may not actually see performance immediately, or you may even suffer more capital, loss while waiting for the cycle to turn. So in the end, tech stock, Inari included, I think you have to watch the narrative by the Fed on the direction of the rates in the US.
All right.
I think maybe I want to explain, to the audience also, why the market actually values tech stock based on the interest rates in the US. You see, tech stock are basically high growth companies. Their earnings, right, is backloaded, meaning that they may not be making so much money initially, but over the longer time, their earnings can be growing exponentially. So if you are going to use PE to value this stock, you are actually understated their value. So what you do is you use DCF, you discount back their future earnings based on certain discount rate. Then this discount rate depends on the interest rates. So when interest rates is high, you actually have to apply a higher discount rate. When you apply a higher discount rate, the discounted value you get is actually lower. So as and when the rates started to fall, you apply a lower discount rate, then your valuation will actually go up. That actually basically happened, say about 2 years ago when US interest rate was at 0. So when you discount back all these potential future earnings with a very low discount rate, right? Certainly your Tesla or your Facebook would be worth a lot more. But now rates are becoming higher. That's why the value actually dropped.
All right. We are running out of time. So let's do one last question, Joshua. So
Sure.
just now you talk about ferrosilicon, you talk about aluminium. So how about steel? What is your view on the steel companies like Anju and so on?
Okay, steel is a bit tricky right now. I think we can tell the steel prices are actually recovering a little bit. But the problem is with your power, your power cost is also going up at the same time. I think they are not out of the wood at this point of time. A lot of them actually are holding a lot of inventory acquired at high prices. And right now, after the steel prices have fallen, you are stuck with inventory at high prices. So as and when you sell, you actually lose money. So you would still have to go through that phase. I think steel companies, steel sector as a whole, the cycle is very short. Right now, given what I have seen, there is still no positive turnaround as yet. I think they are still trying to deplete some of their inventories acquired at high prices.
All right. Thank you so much, Joshua, for doing this very engaging question and answer session with our audience today. So thank you so much for sharing your perspective for the market outlook for 2022 and what are the investment opportunities and which sectors have the earnings resilience. Thank you so much, Joshua.
Okay, thank you, audience, and I wish you a very happy 恭喜发财 Chinese New Year for those who are celebrating Chinese New Year. Thank you.
All right, so let me share my screen. So for those of you who haven't had Kenanga share trading account, you may go to this link, which which I've given you in the chat group. So dco.kenanga.com/create-account/open-account-overviews/EB. So if you want to open a share trading account with Kenanga, please fill up this form and your account will be open online. So if you want to join a Kenanga Trade to Win Telegram channel, this is a link you can click to join the Kenanga Trade to Win Telegram channel. In the Telegram channel, you have a lot of trading ideas on what to buy and what to sell. And one more thing is that after this webinar, we'll also email you a survey form, and we'll appreciate you to give us your feedback into how this session has been conducted. So let us know what is your feedback for this webinar. And last but not least, we also have the CanTrade 2.0 mobile app. All right, so this CanTrade 2.0 mobile app is launched and is downloadable on App Store and Google Play. So this new app is revamped, and so that you can trade the Bursa Malaysia, Singapore, and Hong Kong market. It has a lot of improved features, like you have it has a improved user interface with biometric authentication login. It has the e-payment and e-settlement services available. It enables lot orders and also stop limit orders. It also enable you to do a set up price alert and receive notifications so that you won't miss any opportunity. It enables you to track your portfolio and detailed account summary on the go. It also provide investor with theoretical open and the closing price. It gives you access to the trading view chart and calculator. It has a push notification on trade match and IPO first day listing. It's go green. You can download your statement on a contract note on the mobile app. So you can download it on App Store, Google Play Store, and also Huawei App Gallery. So just go to these three apps, so you can download the CanTrade 2.0 mobile trading app. So with that, we have concluded the session today. So ladies and gentlemen, you just heard from the head of research of Kenanga Investment Bank, Mr. Joshua Ng. So we thank you so much for staying tuned until the end of this webinar. And may all of you here have a prosperous Chinese New Year. And for those of you who are not celebrating, happy holiday next week. All right, bye everybody. So see you in our next CanTrade webinar.